Good morning. We're going to continue working with Perpetual Inventory System journal entries. We're going to look at a new exercise this time from the viewpoint of the seller. I'll do a quick screen share to get started. Okay, so now we're looking at exercise 5-3. In this exercise, we have 3 transactions that have been given to us. We've been asked to prepare the journal entries to record these transactions in the books of Alonzo Company. Alonzo Company uses the perpetual inventory system, and then there's a part B to the problem. We'll get to that in a second. Again, when we're looking at journal entries, my journal consists of a column for date, a column for account name, and the last 2 columns for the amounts to be debited and credited. So let's look at these transactions. On December 3rd, Alonzo Company sold $500,000 of merchandise to Art Company. The terms are 210 net 30. The cost of the merchandise sold is $330,000. Now this is the books of the seller. So the date we have here is December 3rd. On this date, they have made a sale. They have not received the money. They will receive the money in the future. So in their journal entry, accounts receivable will be debited and sales will be credited. The selling price, what's going to be on the invoice is $500,000. Now, if they had gotten this inventory for free, this entire $500,000 would be gross profit, but the reality is they have paid for the inventory. So what was the cost of this inventory? $330,000. Now that they have made the sale, that inventory no longer exists with them, so they need to do a journal entry to update their inventory records. Do they need to increase or decrease their inventory? They need to decrease their inventory balance because they made a sale. So inventory will be credited. That amount is $330,000. Now the question is, what do we debit in this journal entry? This $330,000 is the cost of the inventory. So we call it cost of goods sold. This is an expense account, but we never use the word expense with it. Cost of goods sold. So if I were to ask you for this transaction, what's the gross profit? It's $500,000, the sales, minus $330,000 cost of goods sold. $170,000 is a gross profit on this particular transaction. So whenever a company uses the perpetual inventory system and they make a sale, they will have 2 journal entries. The first one is to record a transaction. Remember, a transaction always means an outside party is involved. The second journal entry is a book entry. We are just making adjustments in our books to these 2 account names that we have over here, cost of goods sold and inventory. Now let's look at what happens on December 3rd. On December 3rd, our company was granted an allowance of $25,000 for merchandise purchased on December 3rd. So on December 3rd, I sold merchandise to Art Company. On December 8th, I'm granting them an allowance, which simply means they're not returning the goods to me. Something was wrong. Maybe it was there was a slight delay in shipment. Something went wrong in the shipment and something was damaged slightly, but they could still sell it. But obviously they're upset with me. So I tell them I'm going to take $25,000 off that invoice price. So there's that much less money I'm going to get. So accounts receivable credit $25,000. I'm basically telling them, okay, you don't have to pay me $500. You're going to pay me $475. So accounts receivable is credit. What should I debit? We never debit sales in a journal entry. That's done only in the closing entry, which is something you still have to see. We never do it over here. So the account we're going to use is sales return and allowance. This is a contra account. You will see that when you prepare your income statement, it'll be sales less sales return and allowance to arrive at the net sales number, a contra revenue account. So we are using that account to keep a track of what happens with all these returns. Then on December 13th, Alonzo Company received the balance due from Art Company. So December 13th, the first thing for me to check is the terms were 210 net 30. I had told my customer, that is Art Company, if they pay me within 10 days of invoice, I'll give them 2% discount, and they have. It's within the 10-day time frame. So I'm getting cash, so cash is debit. I'm going to credit accounts receivable. How much do they owe me? They owe me 500 minus the 25. So that is 475. They're not going to pay me the full 475 because they're paying within 10 days. They get a 2% discount. So they're paying 98%. 98% is 465, 500. The remaining 2% is a discount I gave them. Again, I use a contra revenue account called sales discount. So it's going to be cash debit for 98% of the amount owed to me, sales discount debit for 2% of the amount owed to me, and accounts receivable credit for the entire amount that was owed to me. They have settled the account in full. On part B, they're telling us, assume that the balance was received on Jan 9 instead of December 13th, which means the customer decided to take the full 30 days to make the payment. Fairly straightforward journal entry. Cash debit, accounts receivable credit. How much was owed to me? 475. How much did they pay me? 475. They lost out on the discount. A pretty large amount if you look at it over here, $9,500. So I'm better off in terms of getting that $9,500, but I had to wait an extra 20 days to get that payment. So that's a downside of me having to get the full amount, is I have to wait the extra time. So we have seen two exercises so far. In exercise 5-1, you saw from the viewpoint of the buyer. Now in exercise 5-3, you saw from the viewpoint of the seller. We're going to look at a couple more exercises in a few minutes.